This is Bill Anderson with Robert W. Colby Asset Management. Welcome to How to Protect and Grow Your Portfolio, Part 2. In this video, we're going to review in detail the rules required to implement our simple moving average system. Wouldn't it be nice if we had a decision system that is precisely defined, requires no guesswork, is easy to implement, has stood the test of time, and shows strong reward relative to risk? Well, our simple moving average system can do all this. What is a simple moving average? Well, it's just a math problem. The most popular moving averages in investing are the 50 and 200-day simple moving average. And it's simply the average price over a specific past period of time. And when we calculate these moving averages, we can see a trend. And these 50 and 200-day simple moving averages have served investors and traders well for more than 100 years. They work, people use them. That's what we're going to talk about here. Computing simple averages is relatively easy. To calculate a 50-day simple moving average, we add up all the closing prices over the past 50 trading days of the stock or ETF or index that we're analyzing. We add those up, divide by 50. For the 200-day simple moving average, we use the past 200 trading days of data, then divide by 200. These are easy to calculate on a computer, but they're widely available on many websites for free, without any calculation required. Let me show you using Yahoo Finance. On Yahoo Finance, the first thing I'm going to do is get a price quote for the exchange traded fund with the ticker symbol SPY. SPY is an exchange traded fund, or ETF, that tracks the S&P 500. It's one of the most actively traded ETFs, if not the most actively traded ETF, usually each day. So you put SPY in this little box here and press the button that says Get Quotes. As you can see, SPY is at 159.62 the day I did this. On the left-hand side, you'll see the word Charts right there, and under it the word Interactive. So please click the word Interactive. Once you do that, you'll see this little graph here. This jagged line are the closing prices for SPY over a period of time. At the top of this chart, you'll see the word Technical Indicators. If you click that, this little box will pop up, and click the words Simple Moving Average. Click that for me. This box will now appear. It says Simple Moving Average. In the line 1 period, let's put the number 200, and in the line 2 period, let's put the number 50. Let's do it in this order because the 200-day simple moving average is going to appear red if we do it this way, and the 50 is going to be green, and that's important as we discuss our rules later in the presentation. So 250, and click the word Draw. And magically, all those simple moving average calculations have been now plotted on our chart. So like I said before, the jagged blue line is the closing price for SPY. This could be any stock, mutual fund, ETF. This method works for everything. Take your favorite stock and plug it in and see what you get. The green line is the 50-day simple moving average, and the red line is the 200-day simple moving average. Those are the ones we said we needed to calculate. This was done in half a second. Knowledge is power. Are you feeling more powerful? Good. Now I'm going to tell you, looking at this chart, simple rules to follow to buy and sell. This couldn't be any easier. Here we go. There's only 4 possible things you can do. You can buy, sell short, and cover short. Selling short and covering short require a margin account. A lot of people don't have a margin account, so if it doesn't apply, you can't do it. You may be able to use an inverse ETF and accomplish the same goal as selling short and covering short. The timing of these actions is critical. You need to take action the day you get what we call a signal, and I'll tell you about those signals. When to buy, when to sell, and our simple system is going to answer these questions for you. The first rule we're going to discuss is when to buy your stock, or when to buy long, as some people would say. We buy long when all 3 of the following conditions apply. So we're making it difficult for you to make a purchase here. The closing price has to be greater than the 50-day simple moving average, and the closing price has to be greater than the 200-day simple moving average, and the 50-day simple moving average has to be greater than the 200-day. Only when all three of these apply do we make a purchase. So here's Apple. I'm going to use Apple. Everybody is really interested in Apple. So here you see the 200-day simple moving average red line, green line is the 50, and the jagged line is the closing price. Right here we had just a dip below the 50, but as soon as that crossed over, right here was the last time we bought Apple. Okay? So the price closed above the 50-day, which is the green line right there. And the green line is above the red line, so that's the 50 days greater than the 200-day. And the price is greater than both of those, so that's a buy signal. Okay? So after you buy your stock or ETF, what do? Do you just go away and never look at it again? No, no, no. You have to watch this. Okay? You have to watch this. You have to look for an opportunity now to sell. When you buy and then sell, you want to make a profit. This is making money. So you need to know when to sell and you need to watch this. So here's our rule for selling or selling long. You sell long when any one of these three conditions apply. And we're making it easy to sell. Hard to buy, easy to sell. The closing price, if it dips down below the 50-day simple moving average, sell. Or if it dips down below the 200-day, sell. Or if that 50-day crosses and is now less than the 200-day simple moving average, that's actually a major signal we'll talk about later. You sell in that case as well. So if any one of these three things happens on our chart, you sell. So when do we sell Apple? Well, here's the price going up, 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 up over $700. Then it starts going down. Oh no, Apple's going down. And right here, it crosses the 50-day simple moving average. That is our sell signal that we just discussed. Sell Apple at $652 a share. Don't you wish you'd done that? You could have impressed your friends even more. So there's a sell signal for Apple. So the next rule, and you'll really impress your friends when you tell them you're going to sell something short. Once again, this is only for people with margin accounts, and you have to be a little bit more knowledgeable trader, and you have to agree to a lot of terms and conditions when you use margin. That's beyond the scope of our video here. But you sell short when all three of the following conditions apply. This is during a bearish time, the market's bad, or the performance of your stock or ETF is bad. That's when you sell short. If the closing price is below the 50-day simple moving average, and the closing price is below the 200-day simple moving average, and the 50-day is now less than the 200-day, then it's a good time to sell short. The probability of making money by selling short under these conditions is in your favor. So Apple's price continues to deteriorate, and look what happens. The 50-day, the green line, crosses down through the red line, that's the 200-day, and price is now less than both of those. So now we have the price is less than the 50-day simple moving average, and the 50 is less than the 200. So that is a sell short signal. If you have a margin account, you can sell short. If you don't have a margin account, there's no inverse ETF for Apple. So you really can't do anything. So just stay out of it if you don't have a margin account. After we sell short in our margin account, or we could have bought an inverse ETF, okay, if you don't have a margin account. To get out of that short position, you need to buy to cover short. Now, to sell short, we had to meet three different conditions. But to buy to cover short, we only need to meet one condition. So we want you out of that position at the first sign of trouble. So you buy to cover short when any one of these three conditions apply. The closing price pops back up above the 50-day simple moving average, or the price pops back up and is greater than the 200-day simple moving average, or the 50-day simple moving average crosses above the 200-day. That's a major signal. We'll talk about that later. If any one of these three conditions apply, you buy to cover short, or if you used an inverse ETF, you would sell the inverse ETF. So looking at Apple again, we need to get out of our short position. We're looking to buy to cover short, and this happens right here when the price closes above the 50-day simple moving average, but then you see it falls right back down below, and that's a signal to sell short again. These couple of little trades you made there, we call that a whipsaw, where you get a signal to do something very short term. You may even lose a little bit of money on those trades, but those are shorter term trades, very small losses, and the longer term big winning trades will outweigh those. And you can see Apple continued downward, and there's another buy to cover short signal right there. Okay, now I want to talk about when the 50 and 200-day simple moving averages cross over each other. When this happens, it's a major signal. What I have plotted here is SPY, which is tracks the S&P 500, late 2007 through early 2010. Up here, we have the 50-day crosses below the red 200-day right here. That's called a bearish crossover, and that's bad. Okay, that's bad. That means reduce stock positions to preserve capital. When did this happen? That happened in December of 2007. Remember, the bear market was 2008, so we had a signal before 2008 even started to get out of stocks. And then kaplooey, everybody lost all their money. In March of 2009, we bounced back up. And then right here in the summer of 2009, we had a bullish crossover. So when the 50-day crosses back up through the 200-day simple moving average. And that is good. That is bullish. That means increase stock positions to grow capital and our fortune. So a lot of people didn't get back in the market in the summer of 2009 because their confidence wasn't there. But this system has no emotion. It's technical. It's based on math. It'll give you a signal when there's a signal. And if you follow the signals, you'll be better off. I'm going to talk about something we call the danger zone. This is my chart for SPY. Again, you can see the price in the danger zone. The price falls below the 50-day simple moving average, and the 50-day simple moving average is below or less than the 200-day. This is an extremely dangerous situation. Get out of your long positions or get out of stocks. As you can see, the bottom can just fall out of the price of stocks so fast you won't have an opportunity to protect yourself. There are big companies that have computers that trade faster than you can even think. So the chances of you saving yourself is very slim. So as soon as we see danger, you need to start preserving capital, get out of stocks. After the internet bubble burst in the late 90s and 2000, we had a pretty bad bear market, 2000 to 2002. I've circled the danger zone here. You see, like I said, the price is below the 50-day, the 50 days below the 200-day, almost continuously for 2 years. Don't even try to make money in stocks during a time like this. You're kidding yourself. You're going to lose. 43.9% the S&P lost. The S&P 500, that's the market. During that 2 years, you're not going to make any money buying stocks, so don't try. You may make some money selling short if you're able to do that. So here's 2007 through 2009. Like I said earlier, way up here, there was a major signal to get out of stocks in December of 2007. And then things got ugly, and things got really ugly. And people panicked, and people committed suicide. It was terrible. But this is all very simple. It's all very simple. You shouldn't have even been in stocks. Right? Follow the rules. Protect your capital and your retirement income. You'll have a much happier life. At Robert W. Colby Asset Management, we have more than 44 years of actual investing and trading experience applying such methods. We would be happy to put our experience to work for you. Call me at 646-652-6879. If you want to contact us or get a copy of this presentation, you can send an email to info@colbyassetmanagement.com. Or to learn more about our investment philosophy and our products, go to colbyassetmanagement.com. We hope this has helped you, and good luck in your investing.